All right, let's take a quick overview here, everybody. Hope you're all doing well. Getting ready for some March Madness. Uh, Speaking of mad, you know what gets me mad? And it's kind of funny, but it's kind of annoying. It's like, I'm so sick of hearing about ex hedge fund traders or former hedge fund traders. You see that in the retail world all the time. It's like, oh, former hedge fund trader Joe Blow is going to teach you this, and former hedge fund trader is going to show you that. Well, as someone who actually did trade for a bunch of different hedge funds, I can tell you it's really not that big of a deal. There's a lot of stupid hedge fund traders out there, and a hedge fund is just a type of an account where the manager gets a piece of the action, what we call a performance fee. In other words, say you have a $1 billion portfolio and it's up 10%. That's $100 million. Well, if the hedge fund manager was going to get 20% of the profit, well, guess what? That's a $20 million fee. The mutual fund managers or regular managers, all they get is a management fee. So the hedge funds get the management fee and the performance fee. So, and when you're on a hedge fund, if it's a big one, like where I was, you pay out a lot of commissions because you have to execute trades through a broker. So you have to decide who's going to get your business. So all of these people try to schmooze you, and a lot of the buy side traders, it goes to their heads, and they become very arrogant. Like I was playing golf one time with two of my brokers and a guy that was a buy side trader or hedge fund guy. And, it's like the dude was just like not helping anyone find their balls. It was just a real douchebag. All right. Well, anyway, I don't want to go on that rant for too long. All right. So check this out, right? Sometimes this could be easy. We talked about this 566 level on the SPY, right? Resistance back here, came resistance here, it became support here. And now it's resistance again. So this is the level to watch on the S&P or the SPY, because if the market doesn't get above this, or if SPY doesn't get above 565, 566, well, the market's not going anywhere. So this level has put a top on it right now, or for now, I should say. All right, now we're going to take a look at the tech sector. And see, that's kind of been going sideways there. You see about the levels, though, right? Resistance. Let's take a look at NVIDIA. Another thing I'm sick of hearing about is artificial intelligence. It's like enough already. We get it. Artificial intelligence has been around for years, and the term was first made in the 50s at some conference at Cornell. And in the late 60s, the military was putting a lot of, or I should say, the Defense Department was putting a lot of money into it. And if you could read articles back then that are the same articles you read now, or the same headlines. Will AI take everyone's job? Will AI do this? Will AI do that? One of the first things they used artificial intelligence for was doing credit checks at banks. All right. So NVIDIA, right? You can see this level here, 116 is kind of important. With support back here. Now it's kind of become support again, but that looks pretty quiet. I think one of the things to really watch to see which way this broad market is going to go is Microsoft here, because it's in it, as you can see, it's in this pretty well-defined range. And sooner or later, it's going to break one way or the other. It's not going to stay in the range until the end of history. So trading ranges look like rectangles on charts. So that's why we call them a rectangle pattern. But it's either going to break through and go up, or it's going to break down and go down. And that will probably give us a really good indication of what the broader market's going to do. Yeah, look at it, Larry. And here's something else to look at. This could also this is also something very important to watch, right? So Apple is below pretty important level that's probably going to be resistance around 220. And if you could see today, we made a run at it, got up to almost 219. So support can become resistance because there's people who bought back here that have been underwater since the support broke, and they're like, all right, well, I want to sell, but I don't want to lose any money. So if it gets back to 220, I'm going to sell. So if there's enough of these remorseful buyers placing sell orders, what was support can convert into resistance. And it's a very common thing in the market, right? I was talking about random walk theory, and I was thinking about it. It's really stupid, frankly. If random walk was true, every price level would have the same importance. There would be no support and resistance levels. But clearly, you can see there are. It's another old Wall Street expression: "Those who can do, those who can't teach." And I say it now, it's like because I'm a teacher. Ooh, just kidding. All right, another important thing to watch here. You can see the financial ETF is at an important price level too. So it's going to be fairly easy to determine which way this market's going to head over the next couple days or a week or so. So maybe make sure you check back. Look at that. Consumer discretionary, that support. See how resistance can become support and then support again. Resistance becomes support because of seller's remorse, right? People sell, and at first they thought they did a good thing when the price went lower, but then it goes through their price and they're like, oh, this sucks. If I can buy my shares back at the price I sold them at, I'm going to. So remorseful sellers from here, placing buy orders here, can turn resistance into support. Seller's remorse can also keep support intact. People that sell at the support level regret doing so when the price goes higher. And it's the same thing. They say, if it gets back to my price, I am going to purchase my shares back. So when we get back to the level that had been support, if there's enough remorseful sellers placing buy orders, guess what? It becomes support again. All right, let's look at, I don't know, let's just look at some of these media wonders. Tesla. Yeah, look at that. Tesla, right? Found support at this 222 level. That was the top back here. What am I missing here? Well, actually, you know what? I haven't looked at Amazon in a few days. Let's take a look at that. All right, so it looks like Amazon could be breaking a little bit of support here. All right, let me just look at Bitcoin. The Bitcoin mania has kind of cooled off for a while. Yeah, see, that's been going sideways. But we can see right here, right? It's one of the things we talk about. The support converted into resistance. Now, regardless of what you trade or what people trade, whether it's Bitcoin or a commodity or a stock or whatever, people feel the same emotions. And this is what shows up on a chart. If you didn't know this was Bitcoin, I could tell you this was a stock XYZ, and you would say, okay, right? So support, people buy, goes below the price they bought at. They say they want to get out, but they don't want to lose money. So when it gets back to the level they bought at, they place sell orders. And if there's enough remorseful buyers placing sell orders, support can become resistance. So how do you use this knowledge? Well, it's pretty simple. If you get an idea that something is going to be support or resistance, and the stock or whatever you're trading is going to get to it, there's a good chance that it reverses or makes some kind of a move. Most moves in the market, contrary to what they tell you in the media, is really just based on short-term technicals. It has nothing to do with, well, look at this. It has nothing to do with what they're talking about on CNBC or, whatever website you're looking at. Now look at this, right? So this is oil. This level around 67 has been support for going back now 2 years. So this is a good example of market memory. Sometimes things rally off of support, as you can see here. Support are buyers, and every now and then the buyers start to get impatient and they start to outbid each other, and you get this snowball effect that looks like it's going to go higher. So I'm going to be looking for a move in oil, probably up, but if the support breaks, then we just jump on the downside or on the short side. Oh, sorry. I want to do NG. Natural gas. Yeah, so this is something to watch. We got this kind of ascending triangle pattern here. If we break above 445, probably got some room to go. So this shows us that the ascending triangle pattern shows us the sellers are hanging firm. They're patient. That's why the horizontal line is, that's why the resistance line is horizontal, because they're at the same level. But as time is going by, the buyers are getting more aggressive. They're coming into the market at higher prices. That's why you get these higher lows, is what we call them. When the valley forms at a higher level than the prior valley, we call that a higher low. So the ascending triangle chart shows us a market where there are patient sellers and aggressive buyers, and that could set the stage for a move higher. These patterns are generally pretty reliable. All right, everybody. That's it for me for now, and I'll see you soon. Thanks, everyone.